Welcome back. This is day 2 of Technical Analysis 101, and today we're building our first pair of momentum oscillators, the Relative Strength Index and the Moving Average Convergence Divergence Indicator, better known as MACD. Yesterday, on day 1, we answered the question, which way is price headed, using the simple and exponential moving averages, and we closed with Stan Weinstein's stage analysis framework. Today we answer a different question entirely, not which way, but how fast, and is that speed fading? That distinction, trend versus momentum, is the single most important idea you'll carry out of today's session. So we're going to sit with it carefully before we touch a single formula. We'll build RSI completely from scratch, hand calculate it on real numbers, then do the same for MACD, which is actually built directly on top of the exponential moving average you already know from yesterday. In our advanced module, we'll go further than a typical course, quantifying divergence with correlation, distinguishing regular divergence from hidden divergence, and showing you exactly how RSI and MACD confirm each transition in the stage analysis cycle from day 1. Let's get started. Before we continue, the same important note from yesterday, because it applies to every session in this course. Dreamlit Equity Research and its instructors are not SEC registered investment advisors, and nothing taught today constitutes investment, financial, or legal advice. Everything you're about to learn, RSI, MACD, divergence, all of it, is presented strictly for educational and skill-building purposes. Dreamlit Equity Research bears no responsibility for investment decisions, trading losses, or damages that result from how you apply these concepts in live markets. That application and that risk belongs entirely to you. If you decide to trade or invest using any tool from this course, please consult a SEC registered investment advisor or conduct your own independent due diligence first. My role today is simply to build your understanding of how these indicators work and what they actually measure. What you do with that understanding is your responsibility alone. With that said, let's get into the material. A quick reminder of where we sit in the 6-day arc, because momentum only makes sense in light of what came before it. Day 1, now complete, gave you foundations and moving averages, the simple moving average, the exponential moving average, and basic trend concepts. Day 2, where we are right now, is momentum oscillators 1, RSI, and MACD. Day 3 moves into volatility and trend strength with Bollinger Bands, ADX, and the Commodity Channel Index. Day 4 is momentum oscillators 2, covering the Shan Momentum Oscillator, rate of change, Williams percent R, the Stochastic Momentum Index, and the Detrended Price Oscillator. Day 5 brings volume and adaptive trend tools, Chaikin Money Flow, Elastic Volume-Weighted Moving Average, Zero Lag EMA, and Parabolic SAR. And Day 6 closes with a strategy and fundamental crossover, the Piotrowski F-score, combining signals across the whole course, and a capstone project. Notice the layering, trend, then momentum, then volatility, then a second momentum pass, then volume, then synthesis. You're now 2 steps into that ladder. Here's exactly what we're covering today in 4 blocks. First, a short but essential recap of what momentum actually is and how it differs from the trend concepts we spent all of yesterday on. This framing matters more than it looks like it does. Second, we go deep on the Relative Strength Index, its formula, a fully hand-worked numerical example, how to read the overbought and oversold zones, real use cases, and honest limitations. Third, we do the same treatment for MACD, built from 2 exponential moving averages plus a signal line, with its own formula, worked example, histogram mechanics, use cases, and limitations. Fourth, we close with a strategy spotlight on RSI divergence, using disagreement between momentum and price to spot early signs of trend exhaustion, before price itself confirms the turn. By the end of today, you'll be able to compute RSI and MACD by hand, read what each is telling you at a glance, and understand precisely where each one falls short. Let's define momentum properly before we build any indicator around it. Momentum measures the speed and magnitude of price change, not simply its direction. That's a subtle but critical distinction. A stock can be in a confirmed uptrend, exactly the kind we identified with SMA and EMA on day 1, and simultaneously be losing momentum, climbing, but climbing with less and less force each week. That loss of force often precedes a reversal, sometimes by a considerable margin. So here's the cleanest way to separate the two families. Trend, which we covered on day 1, asks which way is price headed. That's the job of the SMA and EMA. Momentum, our subject today, asks a different question. How fast is it moving, and is that speed now fading? Zoom out to the 4 families of technical indicators: trend, momentum, volatility, and volume. And you'll see trend occupied yesterday's slot. Momentum is today's, and volatility and volume are still ahead of us on days 3 and 5. Keeping these 4 questions distinct in your head is what prevents indicator overload later in this course. Part 1 of today's session, the Relative Strength Index, or RSI. Think of RSI as a bounded 0 to 100 oscillator whose entire job is to flag when a price move has gone too far, too fast, relative to that stock's own recent behavior. Unlike the SMA and EMA from yesterday, which are unbounded and simply track price level, RSI is normalized. It always lives between 0 and 100, no matter what the stock's price is. That boundedness is exactly what makes it so useful for spotting stretch conditions, and exactly what we're going to build from first principles over the next few slides. Here is the RSI formula in full. RSI equals 100 minus the quantity 100 divided by the quantity 1 plus RS. RS stands for relative strength, and it's simply the average gain divided by the average loss, both computed over an in-period look-back window, most commonly 14 periods, from daily price changes. On any day price closes higher than the prior day, that gain counts toward the average gain. On any day it closes lower, that loss counts toward the average loss. 3 quick facts worth memorizing. First, RSI is bounded between 0 and 100, a structural difference from SMA and EMA, which have no such ceiling or floor. Second, the standard look-back is 14 periods, though we'll hand calculate using a shorter window, so the arithmetic stays tractable. Third, the conventional reading is that anything above 70 is considered overbought, and anything below 30 is considered oversold. Break that 0 to 100 scale into 3 bands. 70 to 100 is overbought, meaning recent gains have dominated and the move may be stretched and due a pause or a pullback. 30 to 70 is neutral, a healthy balance between gains and losses, and 0 to 30 is oversold, meaning recent losses have dominated and the move may be stretched and due a bounce. Let's hand calculate RSI on a real sequence of numbers, step by step. Step 1. Collect the closing prices. Assume a stock's last 14 closes are 100, 102, 101, 103, 105, 107, 106, 108, 110, 109, 111, 113, 112, and 114. Walking day to day, the up days produce gains of +2 on 6 separate occasions. Actually 7, let's recount carefully. The gains recorded are day 2 +2, day 4 +2, day 5 +2, day 6 +2, day 8 +2, day 9 +2, and day 12 +2, 7 gains of 2 each. The down days produce losses of -1 on 3 occasions: day 3, day 7, and day 10. Step 2. Compute the average gain and average loss. Sum of gains over the 14 days is 2 + 2 + 2 + 2 + 2 + 2 + 2, which totals 14. Sum of losses is 1 + 1 + 1, which totals 3. Average gain equals 14 divided by 14, which is exactly 1. Average loss equals 3 divided by 14, which is 0.214. Step 3. Compute relative strength, RS, as average gain divided by average loss. 1 divided by 0.214 gives us 4.67. Step 4. Plug that into the RSI formula. RSI equals 100 minus the quantity 100 divided by the quantity 1 plus 4.67, which is 100 divided by 5.67, which is 17.64. 100 minus 17.64 gives a final RSI of 82.36. That reading, 82.36, sits well above our 70 threshold, placing this stock firmly in overbought territory exactly consistent with the steady run of higher closes we just walked through. Now let's turn that number into judgment. When RSI sits above 70, gains have dominated recent price action. Treat it as a signal to watch for a pause or a pullback, not as an automatic sell order. When RSI drops below 30, losses have dominated. Watch for a bounce, not an automatic buy. The third and often most valuable reading is bullish or bearish divergence, where RSI's direction disagrees with price's direction. We'll spend an entire strategy spotlight on this later today because it's frequently an early warning sign. In terms of real-world use, RSI shines in three places: timing entries within a trend that's already been confirmed by your SMA or EMA from day one, spotting divergence ahead of a possible trend change, and in genuinely range-bound markets, fading RSI extremes back toward the middle of the range. But be honest about the limitations too. In strong trends, RSI can ride above 70 or below 30 for extended stretches without ever reversing. So an overbought reading by itself is never a standalone sell signal. You need to confirm it with trend or price structure. And remember, the 5-period RSI we hand-calculated is considerably noisier than the standard 14-period version used in actual practice. For those of you comfortable with R, here's the fastest way to reproduce everything we just calculated by hand, using the QuantMod package. You load the library, pull a symbol like NVIDIA over the trailing year with get symbols, plot the chart with chart series, and layer RSI on top with a single call to add RSI. 4 lines of code recreate the entire 14-period RSI calculation we just walked through manually. The point of doing it by hand first is that now you actually understand what that one function call is computing under the hood, rather than treating it as a black box. Here's what an actual RSI reading looks like layered underneath a real price chart. This is Meta, price on top with its 20-day moving average, RSI, 14 on the panel below. Watch price climb from around 470 through a volatile run past 780, pull back, climb again, and eventually roll over into a sustained decline. Now watch the RSI panel as that decline unfolds. For most of the chart, RSI oscillates comfortably in the 30 to 70 range. But toward the right edge, as price grinds lower, RSI drops decisively below 30, a flagged oversold reading. That's RSI doing its job, signaling that recent losses have dominated so heavily that, on a purely statistical basis, this move is stretched relative to the stock's own recent history. It's not telling you the decline is over. Remember the limitation from a couple slides back. Strong trends can hold RSI at an extreme for a long time. It's telling you conditions are extended. That's useful information, not a prediction. Part 2 of today's session, MACD, the Moving Average Convergence Divergence Indicator. If RSI measures momentum purely from the ratio of gains to losses, MACD takes a completely different route. It measures momentum by tracking the relationship between two exponential moving averages, the same EMA you built by hand on day one. That makes MACD a genuine hybrid, part trend-following tool, part momentum oscillator, built directly on top of yesterday's material. Let's take it apart piece by piece. MACD tracks the relationship between a fast EMA and a slow EMA. When the fast EMA pulls away from the slow EMA, momentum is building. When the two converge back toward each other, momentum is fading, frequently ahead of an actual change in trend. The formula has 3 parts. The MACD line equals the fast EMA minus the slow EMA. The signal line is an end-period EMA of the MACD line itself, a smooth version used to time crossovers. And the histogram is simply the MACD line minus the signal line. The standard industry default settings are a 12-period fast EMA, a 26-period slow EMA, and a 9-period signal line. You'll see those exact numbers, 12, 26, 9, referenced constantly in trading literature. 2 quick facts to hold on to. MACD is unbounded. Unlike RSI's fixed 0 to 100 scale, it reads relative to a 0 line instead. And it genuinely combines trend following through the EMAs with momentum through the rate of change in their spread. Let's read the 3 parts individually. The MACD line is the gap between fast and slow EMA. Positive means the fast EMA sits above the slow EMA, a bullish bias. The signal line is that smooth version used purely for timing. In the histogram, MACD minus signal is where the real nuance lies. Shrinking bars mean momentum is fading even while price may still be rising, which is often the earliest tell you'll get. Let's hand calculate MACD using the standard 12 and 26 period EMAs. Recall the EMA formula from day one. EMA equals today's price times 2 divided by N plus 1, plus yesterday's EMA times the quantity 1 minus 2 divided by N plus 1, where N is the number of periods, 12 or 26 here. The 12-day EMA is more sensitive and reacts faster. The 26-day EMA is slower and reflects the broader trend. Working through 10 days of closing prices, 100, 102, 101, 103, 105, 107, 106, 108, 110, and 109. The 12-day and 26-day EMAs only start producing meaningful values once enough data has accumulated, which is why days 1 through 5 show no reading. By day 6, the 12-day EMA reads 104.5 and the 26-day EMA reads 103.2. The MACD line, remember, is just a fast EMA minus the slow EMA. On day 6, that's 104.5 minus 103.2 equal to 1.3. Continuing forward, day 7, 105.2 minus 103.8 equals 1.4. Day 8, 106.1 minus 104.5 equals 1.6. Day 9, 107.3 minus 105.4 equals 1.9. Day 10, 108.0 minus 106.2 equals 1.8. Notice the MACD line itself is positive and rising through day 9, then ticks down slightly on day 10. That small dip is our first hint that something is about to shift, and we'll see exactly what in the next slide. Step 4. Compute the signal line, the 9-day EMA of the MACD line we just built. Using that same EMA smoothing logic, the signal line reads 1.3 on day 6, 1.35 on day 7, 1.43 on day 8, 1.58 on day 9, and 1.66 on day 10. Step 5. Compute the histogram, which is simply MACD line minus signal line. Day 6, 1.3 minus 1.3 equals 0.0. Day 7, 1.4 minus 1.35 equals plus 0.05. Day 8, 1.6 minus 1.43 equals plus 0.17. Day 9, 1.9 minus 1.58 equals plus 0.32, the widest positive gap in our whole window. Day 10, 1.8 minus 1.66 equals plus 0.14, noticeably smaller than day 9. That contraction from plus 0.32 down to plus 0.14 is the histogram doing exactly what it's designed to do. Even though the MACD line is still comfortably above the signal line and still positive, the gap between them is narrowing. That's bullish deceleration. Momentum is still positive, but it's fading, and it's showing up in the histogram before it shows up anywhere in price. If histogram is greater than 0, the uptrend is gaining strength. If histogram is less than 0, the downtrend is gaining strength. On the interpretation side, MACD crossing above signal is a bullish crossover, momentum turning up. Crossing below is bearish, momentum turning down. A zero-line cross means the fast EMA has crossed the slow EMA outright, a trend change signal in its own right. And divergence works exactly as it does for RSI. Price making lower lows while MACD makes higher lows warns of a bullish reversal. Price making higher highs while MACD makes lower highs warns of a bearish one. Here's MACD laid over a real meta price chart, color-coded by histogram state. Contracting negative, contracting positive, expanding negative, expanding positive. Laid in this chart, a bullish crossover fires as price is basing near its 2026 low. MACD then crosses above the zero line, confirming the shift from a bearish to a bullish regime. But that confirmation is short-lived. Within days, a bearish crossover follows. At that bearish cross, the histogram reads expanding negative at minus 0.340. MACD is pulling further below signal, which the chart labels as aggressive selling pressure and bearish acceleration. This is exactly the mechanism we just hand calculated. The histogram isn't decoration sitting under the MACD line. It's an early warning gauge for how forcefully momentum is accelerating or decelerating in either direction. Here, that gauge is flashing a warning within days of the confirmed bullish signal, a reminder that a zero-line cross confirms direction, not durability. Same pattern as before, now for MACD. Load QuantMod. Pull NVIDIA over the trailing year with get symbols, chart it with chart series, and add the full 1226.9 MACD study with a single call to add MACD. Everything we just built by hand. The fast EMA, the slow EMA, the signal line, the histogram, collapses into that one function call, and now you know exactly what it's computing. Let's convert max mechanics into judgment, the same way we did for RSI. MACD crossing above signal is a bullish crossover, momentum turning up. MACD crossing below signal is a bearish crossover, momentum turning down. And MACD crossing the zero line altogether means the fast EMA has crossed the slow EMA, a slower but higher conviction trend change signal in its own right. In practice, traders use signal line crossovers to time entries and exits within an existing trend. They treat histogram shrinkage as an early momentum fade warning, often appearing well before price itself turns, and they use zero-line crosses as a slower, higher conviction confirmation of a genuine trend change. But MACD carries its own honest limitations. It's still fundamentally a lagging tool. Because it's built entirely from EMAs, it confirms what's already happened in price rather than predicting what comes next, exactly like the SMA and EMA from day one. It has no fixed bounds, unlike RSI's clean 0 to 100 scale, which means its magnitude depends entirely on the stock's price level and isn't directly comparable from one stock to another, a limitation we're going to solve later today with the percentage price oscillator. And in genuinely sideways, range-bound markets, MACD tends to whipsaw, throwing off frequent small crossovers that produce low-quality signals. Let's slow down on the histogram specifically, because it deserves its own careful treatment. It measures the gap between the MACD line and the signal line, and its expansion or contraction reveals momentum physics before any line crossover actually occurs. There are 4 distinct states worth naming precisely. Expanding positive is bullish acceleration. The MACD line is pulling further away above the signal line, and buyers are in complete control. Contracting positive is bullish deceleration. The MACD line is curving back toward the signal line even though it's still above it. Momentum is fading, and that's your early warning, exactly what we saw in our handwork example between day 9 and day 10. Expanding negative is bearish acceleration. The MACD line is diving further away below the signal line, indicating aggressive selling pressure. And contracting negative is bearish deceleration. The MACD line is curving back upward toward the signal line from below, often a sign of short covering and a potential emerging floor. Train your eye to read these 4 states directly off the histogram bars, because by the time a full crossover happens, you've usually already missed the earliest and most useful part of the signal. Let's put RSI and MACD side by side, because seeing their differences explicitly will sharpen your understanding of both. On scale, RSI is bounded 0 to 100. MACD is unbounded, centered on 0. On construction, RSI is built from the average of gains versus losses. MACD is built from 2 EMAs, directly reusing the day 1 building block. On best signal, RSI shines at overbought and oversold extremes and at divergence. MACD shines at signal line and zero-line crossovers. On character, RSI is a pure momentum oscillator. MACD is a hybrid of trend and momentum. And on typical settings, RSI conventionally uses a 14-period look back, while MACD uses 12, 26, and 9. Here's the important synthesis. RSI and MACD are both momentum tools, but they rarely conflict for long, precisely because they measure momentum through entirely different mechanics. One from a gain-loss ratio, the other from EMA spread. A common professional combination is to use MACD crossovers to time entries within a trend, then use RSI to avoid entering just as that move becomes overextended. And the rule of thumb to carry forward. Neither indicator predicts the future. Both simply describe the present state of momentum. Treat an extreme RSI reading and a fading MACD histogram as caution flags that deserve your attention, never as automatic buy or sell orders on their own. Our strategy spotlight for today: RSI divergence. When price and momentum disagree, momentum usually wins eventually, which is exactly why divergence is considered one of the earliest warning signs in all of technical analysis. Bearish divergence warns of a weakening uptrend. Price makes a higher high, but RSI makes a lower high. Read that carefully. Buyers are still pushing price to new highs, but with visibly less and less force behind each push. Momentum is quietly fading before price itself confirms anything is wrong. This pattern often precedes a top or a stalling rally, and it's exactly the kind of signal that prompts disciplined traders to tighten stops or take partial profits, without necessarily exiting outright. Bullish divergence is the mirror image, warning of a weakening downtrend. Price makes a lower low, but RSI makes a higher low. Sellers are pushing price down with less and less conviction, meaning momentum is quietly building beneath the surface before price confirms a bottom. It often precedes a stalling decline, and traders typically watch for confirmation before committing to a long position. One critical caution, and please hold on to this: divergence can persist for a surprisingly long time before price actually turns. It flags rising risk, not a precise entry or exit point. Always wait for price confirmation, a broken trend line, or an MACD cross before acting on divergence alone. We're now entering the advanced module. This is where this course goes further than a typical introductory treatment of RSI and MACD. For things are on the agenda. First, we fix Mac's cross-stock comparability problem using the percentage price oscillator, or PPO. Second, we cover 3 purpose-built RSI variants, each one engineered to fix a specific, named weakness in standard RSI. Third, we move divergence from something you eyeball on a chart to something you can actually calculate with a rolling correlation. And fourth, we build the direct bridge back to Stan Weinstein's stage analysis framework from day one, showing precisely how RSI and MACD behave at each stage transition. Let's start with PPO. Here's the specific problem PPO solves. Mac's magnitude depends entirely on the stock's price level. A $2 MACD reading means something completely different for a $15 stock than it does for a $1,500 stock. The percentage price oscillator expresses that exact same relationship as a percentage instead, making it directly comparable across stocks of wildly different prices. The formula: PPO equals the quantity fast EMA minus slow EMA divided by the slow EMA times 100. Its signal line and histogram are built exactly the same way as Mac's. Only the units change, from a raw dollar gap to a percentage of the slow EMA. PPO reads exactly like MACD in every other respect: crossovers, the zero line, the histogram, which is precisely why it's the tool professional screening platforms actually use to rank momentum across an entire universe of stocks, rather than raw MACD. Consider the before and after. A $15 stock with an MACD reading of 0.30 and a $1,500 stock with an MACD reading of 30.0 look wildly different on paper, even though the underlying momentum condition might be identical. They simply aren't comparable in raw dollar terms. Convert both to PPO, though, and a 2% reading is a 2% reading regardless of price level. Directly comparable, apples to apples. That's why professional screening tools rank momentum using PPO rather than raw MACD. It removes price level entirely as a confounding factor. Let's convert an MACD reading into PPO using the same underlying inputs. From our earlier worked example, a 3-period EMA of 105.5 and a 6-period EMA of 103.5, giving a raw MACD of 105.5 minus 103.5 equal to 2.00. To convert that into PPO, divide by the slow EMA and multiply by 100. 2.00 divided by 103.5 times 100 equals approximately 1.93%. That's the exact same underlying condition. Fast EMA sitting above slow EMA, now expressed as a clean cross-stock comparable percentage instead of a dollar figure tied to this one stock's price. Here's why that conversion matters in practice. If a second stock trading at 10 times the stock's price showed a proportionally similar EMA gap, its raw MACD number would look 10 times larger and far more dramatic on paper, even though nothing about the underlying momentum condition has actually changed. The PPO reading for both stocks, however, would land in a similar range, because PPO measures the relative separation between fast and slow trend as a percentage, not the absolute dollar gap. That's the entire value proposition condensed into one work number. PPO strips out price level and leaves you with pure, comparable momentum. Here's a controlled, real-world test of the comparability problem. On the left, real meta. On the right, a synthetic twin built from Meta's own daily log returns. Rebus to start near $15 instead of several $100s. So by construction, B moves through the exact same percentage swings as every single day, just scaled onto a different starting price. Watch the middle row, raw MACD in dollars. Because B's price is a constant fraction of A's, its raw MACD is that same fraction of A's, compressed by roughly the same ratio as the price gap itself. Read on its own axis, it can look like a completely different momentum profile, even though nothing about the underlying momentum has actually changed. Now watch the bottom row, PPO. Dividing each stock's MACD by its own slow EMA cancels that price scaling factor out completely. That's why the PPO curves for A and B sit almost perfectly on top of each other for the entire window, turning points and all, while the raw MACD panels above them look unrelated. That's the whole argument for PPO in one picture. Raw MACD is real information, but it's only comparable within a single stock's own price history. PPO strips the price level out algebraically, which is what makes it the tool actually used for cross-stock momentum screening. Standard RSI has real, well-documented weaknesses, and 3 purpose-built variants exist specifically to fix them. First, stochastic RSI. Stock RSI equals the quantity RSI minus RSI minimum, divided by the quantity RSI maximum minus RSI minimum. It applies the stochastic formula to RSI itself, measuring where current RSI sits within its own recent high-low range. It fixes the problem we already identified. RSI pinned above 70 for weeks in a strong trend with no usable signal inside that stretch. Because stock RSI is faster and more sensitive, though that comes at the cost of noticeably more noise. Second, Connor's RSI, which averages 3 components. A 3-period price RSI, a streak RSI measuring the length of the current consecutive up or down streak, and a percentile rank of today's move. It fixes standard RSI's biggest weakness for short-term traders, that it's simply too slow for precise mean reversion entries, and it's purpose-built for short-term reversion trading strategies. Third, Cutler's RSI, which uses a genuine, simple moving average instead of Wilder's smoothing. Here's a detail most traders never learn. Standard RSI doesn't actually use a true simple average at all. It uses Wilder's smoothing, which behaves like an EMA with a smoothing constant of 1 divided by n. Cutler's RSI swaps that out for an honest SMA, which is exactly why you'll sometimes see the same 14-period RSI produce slightly different values across different charting platforms. So far, we've spotted divergence by eye, comparing swing highs and swing lows visually on a chart. The problem is that 2 different analysts can genuinely disagree about which swings to compare. A rolling correlation between price and RSI gives you an objective, screenable number instead. The formula, R equals the correlation between price and RSI, computed over an n-period rolling window, standard Pearson correlation, with n commonly set to 14 or 20, matched to whatever RSI length you're using. To be clear, this doesn't replace visual reading of a chart. What it does is let you screen an entire watch list for early divergence candidates programmatically, without having to open every single chart by hand. Here's how to read the correlation output. A reading near plus 1.0 means confirmed. Price and RSI are moving in lockstep. No divergence, a healthy trend. A reading near 0 means decoupling. Price is still climbing, but RSI is no longer confirming that climb with equal conviction. and a negative reading means divergence outright. Price and momentum are now moving in genuinely opposite directions, an objective, quantified warning rather than a subjective eyeball call. Here's a distinction that trips up a lot of newer traders, so let's be precise about it. Regular divergence warns of a reversal. Hidden divergence warns of a continuation. The opposite meaning entirely, despite looking superficially similar on chart. Regular bullish divergence appears in a downtrend. Price makes a lower low, but RSI makes a higher low. Sellers are losing force, and the decline may be exhausting itself. This warns of a reversal upward. Regular bearish divergence appears in an uptrend. Price makes a higher high, but RSI makes a lower high. Buyers are losing force, and the rally may be exhausting itself. This warns of a reversal downward. Hidden bullish divergence appears inside an uptrend. Price makes a higher low, but RSI makes a lower low. That's momentum quietly strengthening beneath a pullback, and it warns that the uptrend likely has more room to run. A continuation signal, not a reversal warning. Hidden bearish divergence appears inside a downtrend. Price makes a lower high, but RSI makes a higher high. Momentum quietly strengthening within a bounce, warning that the downtrend likely has more room to fall. So before acting on any divergent signal, always ask yourself one question first. Is this pattern fighting the prevailing trend, which makes it regular divergence, or agreeing with it, which makes it hidden divergence? Getting that backwards will lead you to exactly the wrong conclusion. Here's a real, confirmed example on Meta. Price sets a swing high near $735 in late October, then sells off sharply. And when it bounces back into early December, it only manages a high near $660, well short of the October level. That's a lower high in price. Now look underneath at the RSI panel across that same window. RSI actually moves the opposite way, ticking up from 59.1 to 59.8, a higher high, even though price couldn't reclaim its own. That's momentum quietly firming up beneath a price structure that looks weaker on the surface. Applying what we just learned on the previous slide, this happens inside an existing downtrend, with price posting a lower high while RSI posts a higher high alongside it. The chart correctly labels this a confirmed hidden bearish divergence. Read as a continuation signal. It's warning that the prevailing decline likely still has room to extend, not flagging a reversal. This is exactly the kind of pattern that a rolling correlation calculation from 2 slides ago would have flagged programmatically, well before you needed to eyeball the 2 swing highs by hand. Let's bridge directly back to day 1. Recall Stan Weinstein's 4-stage framework: Stage 1 basing, Stage 2 advancing, Stage 3 topping, Stage 4 declining. Here's how RSI and MACD behave at each transition between those stages. At the Stage 1, 2 transition, basing into advancing, RSI crosses above 50 and holds there, while MACD crosses above 0. Both indicators confirming the breakout independently. At the Stage 2, 3 transition, advancing into topping, regular bearish divergence appears on RSI, exactly the pattern we defined 2 slides ago, while the MACD histogram contracts even though the MACD line itself stays positive. Early warning signs on both tools simultaneously. At the Stage 3 to 4 transition, topping into declining, RSI fails to reclaim 50 on its bounces, while MACD crosses decisively below 0. And at the Stage 4 to 1 transition, declining back into basing, RSI stabilizes in a tight 45 to 55 range, while MACD compresses back towards 0. Both indicators settling down as the stock enters a new period of consolidation. The core takeaway: never rely on a single lens. When trend, meaning moving average slope from day 1, and momentum, meaning RSI and MACD from today, agree on a stage transition, that agreement is real confirmation. When they disagree, the correct discipline is to wait for more evidence rather than act prematurely. Let's walk through one complete, schematic cycle: basing, advancing, topping, declining, tracing price and RSI together from left to right across all 4 stages. Watch the price and moving average line at the top, essentially flat through stage 1, then rising steadily through stage 2, curving over into a rounded peak through stage 3, and declining steadily through stage 4. Now, trace the RSI bars underneath in lockstep. RSI crosses and holds above 50 right as price actually breaks out of stage 1 into stage 2. That's our confirmed transition from the previous slide. It then drifts gradually downward through the stage 2 to 3 topping wobble, even as price itself manages one more marginal new high. And that combination, price still climbing while RSI is already fading, is the classic bearish divergence we've now defined twice today, showing up in exactly the place theory predicts it should. This is the payoff of everything we've covered so far. Trend tells you direction. Momentum tells you whether that direction still has real conviction behind it. And reading them together is what turns two separate indicators into one coherent picture of where a stock actually sits in its life cycle. And here's that same four-stage framework applied to real metadata, with the background shaded by stage. Gray for basing, green for advancing, brown for topping, red for declining. RSI and MACD plotted underneath in their own panels. Trace the shading left to right. Price opens already in a green advancing stage near $470. That stage isn't a single clean run. It gets briefly interrupted by a topping band around the spring of 2025 during a pullback before flipping back to green and carrying price on up through the $700s. A second, brief brown topping band appears right near the actual peak, just above $780, and from there the chart shifts into a long red, declining stage that dominates the second half of the window. There's a short basing pause within that decline, but no full stage flip. The chart is currently sitting back in red, and the subtitle confirms it. No stage flip this month, still in stage 4. Now look at what's happening in the RSI and MACD panels during that most recent window. The annotation calls out a MACD bullish crossover, MACD cross above the zero line, and then a MACD bearish crossover. All three events compressed into a short stretch, exactly the kind of whipsaw behavior we warned about earlier today in choppy or transitional conditions. This is stage analysis and momentum side by side on a real name, not a schematic, the same reading discipline we just walked through in theory, now applied to live data. Let's close the advanced module with a statistical trigger for fading momentum. The same underlying logic as the QSM method from day 1, applied one derivative deeper. Recall that day 1 applied QSM directly to price returns, to flag structural trend shifts statistically rather than by eye. We can apply that exact same philosophy to the MACD histogram's rate of change instead, which lets us catch a momentum shift before it's visually obvious on the chart. The formula, Z equals the quantity delta histogram minus the mean of delta histogram, divided by the standard deviation of delta histogram, where delta histogram is simply the period-to-period rate of change of the MACD histogram itself, and the mean and standard deviation are computed over a rolling look-back window. Here's how to read it. A z-score crossing beyond roughly plus or minus 2 means the deceleration or acceleration in momentum is statistically unusual for this particular stock. Genuinely out of the ordinary, not just routine noise. Replacing a subjective, does this look unusual judgment with an objective statistical threshold? The honest frontier to acknowledge here. Both QSM from day 1 and this z-score test are asking the exact same underlying question. Has something genuinely changed, or is this simply noise, just measured on a different derivative of the same underlying price series? QSM measures it on returns. This measures it one layer deeper on the momentum of momentum itself. Before we close out today, for questions for you to work through in your own notes, we'll review all 4 together at the start day 3. Question 1. A stock's RSI has been above 70 for 2 weeks straight while price keeps climbing. Does that alone mean sell? Question 2. What does a shrinking MACD histogram tell you, even when the MACD line itself is still positive? Question 3. Price makes a higher high, but RSI makes a lower high. What is this pattern called, and what does it warn of? Question 4. Which of RSI and MACD is bounded between fixed values, and why does that boundedness actually matter for how you interpret each reading? Take a few minutes with these before moving on. They're designed to test whether today's concepts have actually settled in, not just whether you remember the formulas. Let's consolidate everything from today into 6 takeaways. 1. Momentum measures the speed and magnitude of price change, a fundamentally different question from trend, which was our entire focus on day 1. 2. RSI equals 100 minus the quantity 100 divided by 1 plus RS, where RS is average gain divided by average loss, bounded 0 to 100, with above 70 read as overbought and below 30 read as oversold. 3. In strong trends, RSI can stay overbought for a long time. That persistence alone is never, by itself, a sell signal. 4. MACD equals fast EMA minus slow EMA, with a signal line and a histogram built on top of that difference. The standard settings are 12, 26, and 9. 5. MACD crossovers, whether at the signal line or the zero line, are used to time entries, while a shrinking histogram warns of fading momentum before price itself actually turns. And 6. RSI Divergence, momentum and price disagreeing, is an early warning sign, but always wait for price confirmation before acting on a loan. Hold on to all 6 of these. They're the foundation everything in the advanced module today was built on top of. Looking ahead to day 3, volatility and trend strength, covering Bollinger Bands, ADX, and the Commodity Channel Index. Bollinger Bands are a simple moving average envelope built from standard deviation. They visualize precisely how wide or narrow a stock's trading range has become. ADX measures how strong a trend is, completely independent of its direction, and it pairs naturally with everything you've learned across both day 1 and day 2. Here's why day 3 follows logically from today. Momentum, which we covered today, tells you speed. Volatility, which is next, tells you range. And together, the two let you judge whether a given signal is genuinely reliable or just noise. As a structural reminder, days 4 through 6 will cover momentum oscillators 2, volume and adaptive trend tools, and finally a strategy and fundamental crossover capstone, steadily building toward the complete indicator toolkit this entire course promises. That completes day 2. You now know how to compute RSI and MACD entirely by hand, read what each one is actually telling you about a stock's momentum, and, going further than most introductory courses, quantify divergence, distinguish regular from hidden divergence, and use momentum as a live confirmation layer on top of day 1 stage analysis framework. Take some time before day 3 to sit with today's knowledge check questions, and come back ready for volatility and trend strength, Bollinger Bands, ADX, and the Commodity Channel Index. Thank you, and see you in day 3. This has been Dreamlit Equity Research, a reminder that all content in this course is educational only and does not constitute investment advice from a SEC-registered advisory service.